Covered calls. How to make income from stocks you already own. What if I told you that you could make an extra $200 to $500 a month from the stocks sitting in your Robinhood account right now, without selling them? Most people have no idea this strategy exists. Today, we're breaking down covered calls. And by the end of this video, you'll understand exactly how to turn your boring holdings into a cash-generating machine. I'm talking real money, real monthly income, and honestly, this might be the easiest way to boost your portfolio returns if you're not aggressively trading. Let's get into it. Part 1. What the heck is a covered call? Here's the simple version. You own a stock, let's say Apple or Microsoft, 100 shares sitting in your brokerage account. A covered call is when you agree to sell those shares at a specific price on a specific date in the future. In exchange, someone pays you money up front right now. That money is yours to keep no matter what happens. Think of it like renting out your house. You still own the property, but you're getting paid monthly for someone else's right to use it. Here's the mechanics. Let's say you own 100 shares of Apple trading at $180. You sell one covered call contract, which represents 100 shares, with a strike price of $190 and an expiration date 60 days from now. Someone pays you $350 up front. That's real cash. Now, one of three things happens. First, the stock stays below $190 at expiration. You keep the $350. And you still own your Apple stock. You can sell another call next month and make another $300 to $400. This is the most common scenario. Second, the stock shoots above $190. Your shares get called away at $190 each. Is that bad? No. You wanted to sell anyway if it hit that price. You made your $350 premium plus your profit on the stock sale. Win. Third, the stock crashes. You still have your shares. You still keep the $350. And you've actually cushioned your loss. The premium you collected reduces your cost basis. Part 2. The real money math. Let's run actual numbers because this is where people get excited. Say you have $5,000 in your account. That buys you roughly 27 shares of Apple at current prices. You sell one call contract with a strike price slightly above current price. This is called an out-of-the-money call. And it's the smart way to do this. You collect a premium of $150 to $200. That's 3 to 4% monthly return on your capital. Do that 12 times a year? You're looking at 36 to 48% annualized returns just from premiums, on top of any dividends or stock appreciation. Now, most people don't go crazy. A reasonable expectation is 1 to 2% monthly from covered calls. That's still 12 to 24% annually. Compare that to the S&P 500's historical average of 10%. You're beating the market while reducing downside risk. With Fidelity or Robinhood, you can sell your first covered call today if you have the shares. The process takes 5 minutes. You select Sell Call, choose your strike price, choose your expiration date, and boom, money hits your account instantly. Part 3. When this works best, and when it doesn't. This strategy is perfect if you're holding stock long-term anyway and you're okay with it potentially being called away. It's fantastic for stocks you're neutral on. They're fine. You're happy to own them. But you're not convinced they're about to explode. It's especially powerful in sideways markets where stocks aren't moving much, where it falls apart. If you own Apple and you genuinely believe it's going to $300 in the next year, you probably shouldn't be selling calls. You're capping your upside. That's the trade-off. You make consistent income but limited appreciation. Also, covered calls have tax implications. If your shares get called away, it's a capital gains event. If you're in a taxable brokerage account and you have gains, you'll owe taxes. If you hold them in a Roth IRA, no problem. You can't sell calls in a traditional IRA, but Roths allow it, and it's completely tax-free. That's why your Roth is potentially more powerful than people realize. The bottom line, you have assets sitting around. They might as well be working harder for you. Covered calls turn passive holding into active income generation. It's not complicated. It's not risky if you understand it. And the monthly income compounds like crazy over time. If this opened your eyes to a new income stream, smash that subscribe button right now. We drop new personal finance strategies every single week. And comment below, what stock would you sell calls on first? I read every comment. Let's go make your money work harder.